getting on the radar of acquirers, oftentimes the best way to do it is to take business from them.
So, Juan, let's get to know you a little bit better. Tell us about yourself and your background in your own words.
First of all, thanks for having me on the exit. Always enjoy speaking with you, and happy to share some perspectives today on the M&A market and what I do for a living. So yeah, look, I've been doing investment banking for about 20 years. Prior to banking, I had spent about 10 years in IT and software. So I kind of had a technology background. And over the last 10 years, where I've really focused is on what I call commerce technology. So that is software businesses, agency businesses, data providers, even hardware companies that are all either helping retailers, consumer goods manufacturers, or B2B manufacturers with their technology needs somewhere along that commerce journey, right? All the way from product inception, things like product lifecycle management, to marketing technology and services, to last mile logistics and warehousing. In terms of where I am now, as I said, I've been doing banking for about 20 years, spent the last 2 years here at BrightTower. BrightTower is a middle market investment bank. All we do is advisory, meaning we don't have our own fund. We're not investing our own capital. We don't do IPOs or sales and trading and equity research, but we advise companies. They can be founder owned, they can be VC backed, private equity backed on selling their companies. We often advise buyers when they're looking to acquire a company. And then we'll also do some later stage capital raising. Our firm focuses just on three areas: software, data, and information services. And so commerce tech being my particular area of expertise.
I don't think there's many bankers that know it better than you do. So
Thank you.
you've been doing
Thank
it for
you.
a long time. Okay, so for the audience members who may not know, Juan supported Pacvue throughout our acquisition process. And so before we get started, I'd love for our listeners to hear how you became Pacvue's banker during our acquisition. How do we get on your radar? And what drew you to work with us and how our partnerships came about?
Yes, I really enjoyed working with you and Jiawei. I think we're doing a very important service for founders like yourselves, and we have to have fun along the way. And so I think, along with my team, you, Jiawei, and your team, we kind of had fun as we were doing the
Mhm.
process. And that's really, not only just spending time with you during the process, but just, having fun and getting to know you was really enjoyable.
Yeah. When you're going to spend that much time with someone, it's good if you like them. So next, I really want to bring up an interesting graphic that gives an overview of the rise in M&A deals leading up to the peak in 2021. Can you tell me more about the trends leading up to this spike and why the bubble burst, and then what we can expect following the election and into 2025?
Leading up to those big volume spikes that you saw in 2020 and 2021, it was a bit of a perfect storm, right? And so, first of all, the world didn't end during COVID. Consumers were spending a lot, not only on products, but also on services. Interest rates were low. There was no Ukraine war, there was no Gaza conflict. And then, frankly, sometimes you have a bit of FOMO from investors and acquirers when they see everyone else around them making acquisitions. They kind of want to participate. And so it was really that perfect storm that drove everything up during 2021, not only volumes, but also, as you said, deal multiples as well. But then interest rates started going up. First of all, it cost buyers more to finance the acquisitions that they were going to acquire. So that brings down the price. And oftentimes what we see in M&A markets that start to shift is you may still have sellers expecting this price, buyers being down here, and you have a disconnect. So interest rates going up was a real hit. Plus inflation, right? Wages, materials, you name it. Plus the Ukraine war, which started in early 2022. And then when it comes to anything around e-commerce, software, services, agencies, businesses in particular, it turned out that humans actually like to go into stores and shop. And so e-commerce really started slowing down, and brick and mortar saw people coming back into stores. So all of that made a bit of the, perfect storm in the other direction, and really caused volumes to drop in 2022, 2023. I would say, I know that the chart shows a little bit of a rebound in 2024. We kind of feel like and are seeing that 2024 is probably going to be fairly similar to 2023. But We do see some momentum heading into 2025. We kind of gauge it by the number of pitches that we're invited to. And we've seen an acceleration in the number of pitches that we've been approached to participate in, whether founder owned, private equity backed. We think that with the interest rates coming down, again, yesterday, interest rate drop, with clarity around the election, with private equity and strategics still sitting on billions and billions of dollars of cash that they haven't put to work in a few years, next year should see an acceleration again. I don't think we're going to get to the 2020 and 2021 types of volumes or multiples. It had taken 20 years for that to happen the last time, right? The dot-com era to then 2020 and 2021. Maybe in 2041, we'll see some similar types of multiples again.
So we were either extremely lucky or strategic to have sold Pacvue in 2021.
Well, Xiaowei is one of the smartest people I've ever worked with or worked for. And I don't think it was luck. I think it was very strategic for both of you.
So Juan, when it comes to determining valuation, what's the current thinking? For example, are you seeing a specific number on multiples of EBITDA, revenue? Does it differ for agencies versus software companies? Walk us through the steps to arrive at a valuation.
Generally speaking, agency businesses will trade on multiples of EBITDA, right? From day one, an agency should be profitable and therefore have EBITDA. And so the types of buyers that acquire agencies are typically looking at EBITDA. On the other hand, higher growth software companies, which oftentimes, especially if they're enterprise software, don't have any EBITDA, right? They're investing everything in R&D, they're investing everything in sales and marketing. Those tend to trade on multiples of revenue, multiples of ARR. They also oftentimes have annual contracts, right? So there's just so much more revenue visibility that they'll trade on multiples of revenue. I guess the last thing I would add is for more mature software businesses that are perhaps slower growth but profitable, those tend to flip over and end up trading on multiples of EBITDA. So there is kind of a combination of both in the software world. But to go back to the 2020 and 2021 era, software, for example, a lot of companies in that era were trading at 20 times revenue, 25 times revenue. Those same companies in this current environment, it might be 6 or 8 times revenue, right? So there's been significant compression. On the agency side, we saw a lot of companies back in the 2021 era trading at high teens, even low 20s EBITDA multiples. Those same companies today, maybe 12 or 14 times EBITDA. And so there's been compression, but not to the same extent as there has been in software. And so again, going to that disconnect that we've seen in the market, things are starting to kind of recalibrate where a lot of sellers are appreciating the fact that, hey, we missed the days of getting 20 times revenue. And so if we have a nice, attractive business, we're back to the multiples that we had pre-2020, which, again, there's a lot of different analyses that people do. But generally speaking, for a decent software business growing at a nice clip, 20, 30%, about 6 times revenue has just historically been kind of where we've seen the market.
Okay, 6 times revenue. All right, good to know. I think there's a lot of people that saw all those valuations in 2021 and were surprised, like you said, but good to know that's recalibrating a little bit. There's a few different approaches for founders to exit. What are the various exit options that founders have and how do they work?
Couple pieces in there. So for starters, when we talk about different options for raising capital, we usually break it into two, either raise debt financing or sell equity. And so on the debt financing side, the positives and the benefits of that are you don't have to take any dilution, right? If you're a founder that owns 100%, you put some debt on the business, you still own 100%. The downside is just like having a mortgage, if there's time in your business where things aren't going exactly to plan, your lenders are going to take over your business. And so that's where debt can work against you. When it comes to equity, there are a few different ways that we think about it. So there's venture capital, usually for software companies and usually for earlier stage software companies. When venture capital comes in, it's typically for a minority investment and they want all that capital to go on the balance sheet. You, as the founder, typically aren't going to get any liquidity in that event, right? The VCs want you sweating, working your butt off every day to make that equity worth a lot more. The next tier, call it, would be growth equity. So these are sometimes later stage venture capital firms, earlier stage private equity firms that will do, again, minority investments. And oftentimes they'll allow the founders to take a little bit of liquidity, right? It's almost a different mentality from that group. Their mentality is, hey, if you founder no longer have to worry about your mortgage, about your kids' education, now you can really spend all your time focused on the business, right? And so just a different take on it. And then the kind of final piece would be either bringing in private equity or strategic for a majority recap, we call it, or a full acquisition. And so there, of course, when you're selling your entire business, unless, and we can talk about things like earnouts or equity rollover, you're kind of done, right? If you've sold your business, you're now, there is no participating in the upside. So those are kind of the way that we think about the different tranches. And again, importantly, software usually for venture capital. We've seen some agencies and some agencies even in the Amazon ecosystem raise from venture capital, but it's typically reserved more for software and data type businesses.
I know that preparing for an acquisition requires a certain level of readiness. What are some foundational elements like financials, the team in place, the market position that agency owners should have before they even consider beginning the process?
Look, at the end of the day, sometimes acquirers will come in, they know the business, they know that they're lacking in what this particular business has, and it doesn't matter what your books look like, they just want to do the deal. That's kind of few and far between. So what I would always recommend founders do, and this should be ideally from the start, but if you didn't do it from the start, at least start today, keep good records, right? And keeping good records means your client and vendor contracts, have those at the ready, your leases, your articles of incorporation and bylaws, your tax filings, right? Your IP, anything that you utilize and that's required to run your business, you're eventually in a sale process going to have to share all of that with the buyer. And so the more quickly you're able to provide that, the quicker that a process can go. So you definitely want to just have all your records straight. When it comes to financials, ideally you want to be, if you're a US company, doing them from the start on a GAAP basis, not a cash basis. Using something like QuickBooks is fine early on, kind of a starter type of capability from a financial record keeping perspective, but it gets the job done. And then even from a kind of resource perspective, having somebody in the organization that handles finance or even having an outsourced CFO, any of that will help. And I know you, as you mentioned, for you, like finance was just, you didn't even have time to think about it. But if you can have somebody again early on that's just responsible for the books, or somebody, of course, that is kind of a jack of a lot of different roles in an early stage company, just tracking the financials is extremely important as well. And the final piece I would add onto that is, as you think about your financials and really your customer data, you want to track your customer information as granularly as possible, meaning you want to be able to show your revenue by customer, by month, by product, by geography, by whatever capability or piece of business logic makes sense for your particular business. Because that was one of the things that Pacvue did extremely well, was even though the financials were kind of outsourced and, kind of left to be done a month after the month closed, your database of what you tracked for clients was extremely valuable. And we were able to look at that and slice and dice it and present it to buyers in a myriad of ways that was helpful in really understanding the business. And so that is, again, a very important aspect of this, tracking your customer detail by month, however you think about it.
Just to have the telemetry internally to understand your customers and what's working, not to mention the deal. What type of team does a founder need to have in place to make sure you avoid unnecessary pitfalls in the acquisition process?
You have to have a good lawyer. Deals sometimes get done Without bankers, that's disappointing to me. But at the end of the day, you need to have a lawyer that's protecting the risk side of the equation when you're going into a sale process. You have a purchase agreement that can be 60, 90, 100 pages long. That is critical. A banker is certainly recommended from our perspective, founder-owned business, private equity-backed business, regardless of what the business is, because there's a lot of value that we bring into the process. Having a good lawyer, a banker, and frankly, a good accountant and tax person, those are probably the three key things that you want that maybe are not necessarily internal to the organization.
Can you tell us a little bit about how long the process typically takes once a company has engaged with an investment banker?
It can be a little bit all over the place. These days, when we go in to pitch business, we're typically working with a timeline that's about 6 months from the time that we get engaged until the time that you actually sign a deal. And it could be shorter. Sometimes processes that we've run get preempted. So somebody comes in and just says, hey, I want to own this. I'm going to move more quickly. And so something can happen in 2 months or 3 months. And then sometimes, depending on a lot of different variables and the types of buyers, it can run longer, especially if it's big strategic acquires, these big public companies that have lots of levels of approvals and maybe looking at 20 other acquisitions at the same time. If that's your buyer base, it just sometimes can extend processes.
Yeah, something like a holding agency might have a lot more red tape in acquiring an agency.
Yeah, certainly from an agency perspective.
Juan, can you tell us a little bit of the common pitfalls agency owners should be cautious of when they're entering the acquisition process? Are there unexpected challenges that tend to catch people off guard?
I think the one thing that I've seen most frequently over the years is that sellers wait a little too long to bring in a banker. And so I've had multiple situations where I've been brought in, and by the time I've been brought in, it turns out that a lot of information was shared with the potential buyer, and sometimes it's information that's stale. So at one point, I was selling a public company, and they got approached by an acquirer, private equity firm, because they were interacting directly with the buyer. They ended up sharing projections with that buyer as soon as they asked for them. When we got engaged, we were told, yeah, we shared some financials, but they're stale. They're too aggressive. We're not going to hit those numbers. So we had to work with the company to revise their projections, share it with the buyer. The buyer had already put in an initial indication of interest. That buyer ended up walking away because they said we were already kind of stretched at the valuation that we were, and that was with the old financials. Now you're giving us these new, more conservative financials, and your board had told us before that we needed to be at an even higher price. So now you give us worse financials, but you want an even higher price. And so I've unfortunately seen that too many times. So be very careful if and when you share projections. But again, it's a benefit of having a banker come in early, not only to help guide you in terms of what you share and when, but also to be a buffer, right? So part of our value as an agent is to be a buffer between the buyer and the seller. You, Melissa, when you're selling your business, you should not be interacting directly with the buyer, because if they're eventually going to be your boss, the last thing that you want to do is say no or push back or take a week to get back to them on some request. That's what we're there to be sometimes, is the bad guy that says, hey, we'll get to it, or we're not even going to provide that at all. And so that way you, as the founder or as the seller, maintain your positive relationship with the buyer, and you have the intermediary being the banker dealing with all the minutia and the interactions with the buyer.
That's the one time you can not be accountable for things, sounds like. Given your expertise, what's the biggest piece of advice for founders looking to be acquired?
In addition to, keeping your records and tracking your financials and your customer data, to execute on the business, meaning overall, your time should be spent focused on growing your business and executing on your business. I do think it's smart every once in a while to lift your head up if a investor reaches out or a banker reaches out, because you can learn something about what's happening in the market, or you may end up just establishing a relationship that 6 months, 2 years from then may end up being the banker that you work with or the investor that ends up investing in your business. But again, I've seen sometimes I had a situation where a founder was running a sale process himself, was spending all of his days responding to all these requests that were coming in from the buyer, ended up taking his eye off the business. The business did not do well during that 3, 4, 6 month period where he was trying to sell the business. Again, that buyer walked away because if you're telling them your projections are going up to here, and during the process your projections are flat or down,
Mm-hmm.
that buyer is going to walk away. And so keeping your eye on the business, I would say, is frankly the most important thing. In terms of getting on the radar of acquirers, oftentimes the best way to do it is to take business from them, right?
Mm-hmm.
So you get on people's radar when your name keeps coming up as the company that just beat them in the second or the third or the fourth pitch. And again, that's from executing and making sure that you're delivering on your business objectives. If you're not a true competitor with a particular party, but there really are synergies and you're complementary to each other, establishing a partnership is a terrific way to get on their radar. Going to industry conferences, right? The M&A people from big strategics are always at these various industry conferences. And
Mm-hmm.
if you have a booth, or even if you're just setting up meetings, I find, especially kind of in this commerce tech world, that there are a few big conferences that everyone seems to go to. And so that's a terrific opportunity. It may sound funny, but growing is a great way to get on people's radars. For example, private equity does a terrific job of going through LinkedIn or using tools like SourceScrub, which help them identify potential targets based on an industry, based on headcount, based on estimated revenue. And so the more that you grow, if you have 50 employees on LinkedIn or 100 employees on LinkedIn, all of a sudden you're going to get on people's radars. I always kind of joke with people that part of the reason that Pacvue wasn't on everyone's radar was that I think at the time that we got engaged with you, there might have been like 30 or 35 people on LinkedIn. What
Mm-hmm.
people didn't appreciate was that there were 120 people in China that don't use LinkedIn, right?
That's
And
right.
so your business was so much bigger than anyone ever estimated. So it can be misleading, but again, it's a good metric that some buyers use. And then the final thing I would say is the other way to get on buyers' radar is through bankers. First of all, I have industry landscape pages that I keep, for example, on the Amazon ecosystem, all the software companies, all the agencies. And in my travels, talking to private equity firms or talking to strategics, I'm oftentimes sharing that page. And so there's a lot of logos on there, and you may end up getting on a buyer's radar because of that. The other thing that we do is we'll oftentimes make introductions. So we can introduce you to a strategic that you think would be a terrific partner or a terrific acquirer that you just have never had an opportunity to connect with because, again, having a Rolodex is a big part of what we bring to the table when we're selling or advising companies on a transaction.
So, a couple takeaways from that for founders out there: make sure your people are updating their LinkedIn profiles that they work at your company. And fun fact, I think that I met you several years before we even engaged in any kind of deal activity at a conference. So, I
We
think it
did.
was Shop Talk. So, both of those, all those things that you said are definitely true. Last question: how can people contact you?
Speaking of LinkedIn, I find that LinkedIn is the best way. So Juan Mejia at BrightTower is just the easiest place to find me. I check it quite frequently, so I'll get back to you.
Awesome. Or at the next commerce conference, I'm
At
sure.
the next Commerce Conference. Yep.
Awesome. Okay. Thank you, Juan. Thanks so much.
Yeah. Thanks for having me, Melissa. Nice to see you.